We're going to be talking about donor advised funds tonight. And, the reason that I wanted to do this one is I actually had a few clients where this came up just in our conversations. I'm like, you know what? We need to make sure that there's something out there for everybody to understand just quickly what a donor advised fund is, how it can work, and how it could potentially help you with your charitable giving strategies. So I'm Bob Gavlak here with my partner, Shaun Carney. So we'll be going through it tonight. So thanks everybody for being on. And as always, just pop in, ask questions as we go. There's a question area in the Zoom webinar here, so just ask away. Ryan is out today, so we're hoping that Shaun can handle any of the technical questions that we have come up. So Shaun, you're on for that one. Um, but really for today, we're going to go over what is a DAF, a donor advised fund. I want to go over just a quick tax review to walk through how the tax system works and how a donor advised fund can make sense, even if you're only giving a few $1,000s a year to charity. Talk about how it can help some planning ideas, just some general resources, questions and answers, all that good stuff here today. So I'm just going to go ahead and kick it off. Shaun, do you have anything to add before we dive into this?
No, I think this is a timely webinar given we've got about 19 days here to process our taxes. So maybe some last minute planning, but ultimately a way to kind of help everyone put a different strategy in place. And we do get a lot of questions about them. There's a lot of uncertainty. So hopefully this will provide some clarity for everyone that's thinking about it.
Yep, perfect. And hopefully line it up for 2026 if this does become a question. So let's just start at the very top. What is a donor advised fund? So, in its simplest sense, it is just a charitable investment account. It is set up by a donor, right? So, if I were to set one up, I would set it up through an institution, but it is not an account that I own. It is set up through a separate institution. And there are lots of different ones that do it. We have Schwab Charitable that does it. We have a number of different third parties that we work with to do it. I've even heard for those that are at Altruist, we have Altruist is working on a donor advised fund, but it's just an investment account that is held and owned by the charity, not the individual, but it's directed by the individual. When you donate to this investment account, you get the upfront tax deduction for the amount of money that you put into the donor advised fund. So you immediately get that upfront tax deduction for whatever amount you contribute to the donor advised fund. Then what happens is the contributions can then be invested. So it would be very similarly set up as like a brokerage account at Schwab. This is where a lot of our clients have them currently, is they put $50,000 into the um, charitable account. It can then get invested however we want to for short or long-term needs, and then we can distribute over time out of this account. So one of the nice things about our donor advised fund is kind of like if we think about like the large foundations that we see out there, right? Like, the Bill and Melinda Gates Foundation, where you put money in there and then they decide how to distribute it out over time. Very similar setup that you're doing with a donor advised fund. You don't then need to go and push it all out. You can parcel it out over time. So I thought a little graphic might be helpful to do to explain this a little bit better. So basically, we got the donors here, right? This could be, I'm gonna make this about me because it's easy, Shaun, right? So this is gonna be me and Heather here as the couple. We're gonna be the donors, and we set up a donor advised fund. And again, it is not under our names. It would be at like American Endowment and Foundation, and then we name it the Gavlak Family Charitable Fund or something like that. The fund is set up. We are then able to contribute cash and or securities to the donor advised fund. And whatever amount we contribute, we immediately get that tax deduction in the current tax year. So if we put in $50,000, we get a $50,000 tax deduction in this year for the contribution. And then again, when it's in the fund, it can now be invested. And maybe we buy, a whole bunch of, I don't know, Tesla stock or something, and it grows. Now, all of a sudden, instead of just having 50 to distribute, we have 100 that we can distribute, and we can share it with charities and make recommendations for grants at any time. So, in this scenario for me and Heather and the Gavlak Family Charitable Fund, if we have $50,000 in there and we want to send 2,000 to Samaritan's Purse and 3,000 to a church and 5,000 to Case Western Reserve University, we can send those out as we want from the fund. When we send them out from the fund, though, there is no tax benefit on that end, right? So we don't get like an additional tax deduction or anything like that. We only get it on our initial contribution to the fund on the front end. So that's, just kind of laying it out simply. Anything to add there, Shaun, or any comments or, thoughts?
Yeah, I think, some of the ways that we see people use this is maybe they don't know where they want to donate just yet, but they're looking for a
Mhm.
tax break. They haven't done their research, or maybe they know one or two places they want to give it to, but they want to continue to kind of look at different endeavors. So it's a great place to park some money. You get the current day tax deduction, and maybe you're waiting for that new charity to start, or you want to do a little bit more exploration. You can continue to let the money grow. And then once you found the places that you want to go, you could then assign it. So you don't have to assign it when you're making the donation. You don't even have to know where you're going to give it. You're giving the current date year tax deduction, knowing that in the future you're going to assign where you want that to go.
Yep, absolutely. And I think that's a great point, Shaun. And not only if you don't know, but maybe you just don't want to give all of that money right now to that charity, right? Like maybe, I went to a small private high school, Holy Name, up in Parma Heights, Ohio, and maybe I want to give them $20,000, but I want to spread it out over a few years. I could use this to just kind of parcel it out when I want to and as I want to, but at least I get the upfront tax deduction on the front end for it.
Now, I'll kind of make another idea, right? So, what I would like to do, you kind of talked about the Gavlak, charitable donation, is one of the things I'd like to do is start a foundation in the future to
Mhm.
help youth athletes that are, maybe not as fortunate, help them get cleats, help them pay for tournaments. Lord knows I'm going through it right now. These travel sports are expensive. And so I'd like to be able to help them in the future. So I can start making my donation to this donor advised fund when I either find a charity or start a charity on my own. Then I can say, okay, I'd like to assign it to that charity. And now we have a solid foundation to start making those donations.
Yep, absolutely. It's a ton of flexibility that it offers on the front end. Now, there are some rules that come with it from a donor advised fund perspective. All the distributions must be to a qualified 501(c)(3) organization, right? So if like in that case, Shaun, that Shaun brought up, say there was just a family in need that needed something, you couldn't ask the donor advised fund to give to just a family or something like that because they're not a qualified 501(c)(3). So the distributions out need to go to actual charities that are, registered with the federal government, the IRS, all that stuff. So you need to make sure that that's the case there. When you put the money in, as I mentioned, it could be cash or securities. I'll touch on this in a planning idea later in the webinar too to help kind of drive that point home. One important thing that I like to point out, this is considered a completed gift at this point. So as soon as you take, so in that my scenario I put in there last time for me and Heather, as soon as we make the contribution to the donor advised fund, say it's $50,000, that is now completely out of our estate. Like we can tell or direct the foundation where to send it, and they 99.99 times out of 100 will follow it. But it is no longer my money. Like I couldn't be like, you know what? No, I want that money back or anything like that. It is considered a completed gift and cannot be reclaimed. There are some rules where it may be subject to some AGI limitations. And then for any of us that are really having fun with like required minimum distributions and RMDs, and we're getting into the qualified charitable distribution side of things or QCDs, you cannot use or you cannot fund a donor advised fund with a QCD. I wish you could because that would just be a beautiful planning opportunity right there. But unfortunately, you cannot fund your donor advised fund with a QCD.
And I would also say, normally when we're reading the literature on this, it says for now.
All
So I
right.
think this is something that the IRS and people want to be able to do. It
Mhm.
is just not allowed right now. So we know that the tax law changes constantly. This may be an area in the future that does open up.
Yep. Yep, good point. So, but for now, this is how it's set up. This is how we can fund it. And what I want to do in this next section here, and Shaun, if we get a question or anything, just feel free to stop me as I'm going through. But I just want to walk through why and how this can make sense, especially just revisiting basic kind of how the IRS tax laws work for us. So, I'm going to do a quick tax review, and then we'll get right back onto donor advised funds. So, I want to talk about just standard versus itemized deductions really quick. So for 2026, if you are married and you file jointly, we've got this left column here. This is the standard deduction. So everybody gets this tax deduction on their taxes, whether they have anything to itemize or not. In order to not use the standard deduction, you need to exceed it with whatever your itemized deductions are. So let's pretend, and I'm just making up this scenario here. Let's pretend you have $8,000 that you pay in property taxes. Let's say you have $5,000 that you paid in state income taxes. And now, with the recent tax law changes, the SALT cap has gone up to $40,000 from just 10. So you can actually take advantage of all 13,000 of this in this scenario. But keep moving on. Let's say you have $4,500 in mortgage interest and you were charitably inclined this year and you gave $5,000 to charity. So if we add all this up, this is what, about 10, 12, 5. This is about 22,500 of itemized deductions. And because it's below the standard deduction, you effectively don't get any tax benefit for this. Now, I want to make something very clear before I kind of dive into this. I don't think Shaun, you, me, anybody gives charitably just for the tax benefit, right? And if we do, like, there's a different conversation to be had, right? But we're not trying to say, hey, we should only do this if there's a tax benefit. That's not it at all. We give charitably for all kinds of reasons. But if we can optimize a little bit and adjust some things to take advantage of the tax law, that's where it's like, hey, we still want to give charitably. And if we can make it even more impactful for you or for the charity, I think that's a benefit for everyone. So that's kind of that. So in this scenario, if you were given $5,000 a year to your church, a charity, an alma mater, whatever it is, and we look at this, what's called the standard deduction gap. Let's say you did this, excuse me, for the next 5 years. You just were given to the charity for 5 years. You're running into that same scenario over the next 5 years where you're giving $5,000, you're giving it to your CPA when they file your taxes, they're taking it all in, but guess what? You're still getting the standard deduction. Effectively, that's $25 in donations with no tax benefit. That's how the current tax law is set up. This is how it works. Now, if we go back to that same thing and we say, you know what? Let's accelerate this and let's make it a $25,000 charitable donation. So now the standard's still 32.2. All of a sudden now, layered on top of our other itemized deductions, we now have a charitable contribution of $25,000, which now we have itemized deductions of 42,500. Now all of a sudden we get an extra $10,000, $10,300 deduction on our taxes, and we are starting to get a benefit. And now, if you had even more, right, if you had more mortgage interest or more state income or property taxes, or you gave more to the donor advised fund, the more that you exceed this standard deduction, the more that you're creating a benefit for those dollars that you're donating. So when we take that and we run it through this same strategy, what happens is we're giving that same $25,000 in donations, right? We give it to the donor advised fund. We can still distribute it year by year if we'd like to, but at least we get some tax benefit from that deduct or from that contribution on the front end. So Shaun, I went through that quickly. Is there anything that I missed from just a tax perspective and or just kind of thinking about this in how the deductions work?
I think that was really well summarized and very clear based on the wonderful graphics you put together, Bob.
Hey, listen, I am a numbers guy. I am not a graphics guy. I leave that to the people that are much more creative than me. So thank you, Sean. So,
Amen.
uh, and so this is where, again, this is just kind of one of that low-hanging fruit that we can utilize a donor advised fund for something like this. And I just like to revisit this again because Sean, you picked on my graphics early enough. I actually found this one online and I just kind of stole it because I felt like it kind of brought it all back together for us really well. So just as a reminder, revisiting how they work, we give to a donor advised fund. You can grant cash, stock, real estate. You can grant closely held business interests. You can grant just about anything can go to a donor advised fund. You get immediate tax deduction. You can then let that grow. So again, if that 50,000 gets donated, let's say it's $50,000 and I'm stealing some of my own thunder, but let's say it's $50,000 of a highly appreciated stock. Like you have, you know, JP Morgan stock that has grown over the years. You just give that stock and instead of paying capital gains to sell it, you just donate it to the donor advised fund. All of a sudden it goes into the donor advised fund. You can sell it and diversify it, and now that can grow without the concentration risk of just being in one individual stock, where it's much harder to do that on the personal side to diversify from concentrated positions. So, again, that grows. And then you grant it to qualified charitable organizations at any time. It can be this year, it can be 5 years. Now, there is some rule, Sean, I forget the exact numbers, but like a certain percentage needs to be distributed over 3, 5, 7 year periods. But effectively, the way that these are drawn up is they can kind of go into perpetuity, because they can go until you pass. You can put your kids, grandkids, family members as successor trustees of the donor advised fund, and they can all ultimately carry on those charitable intents as well. So, again, you give, you let it grow, and then you grant from the donor advised fund versus just individually giving out to charities or a charity over the course of time.
Yeah, and I think you hit on a point that one of the questions that came in was what happens to my donor advised fund contributions after I pass. And so you kind of
Mm.
mentioned it could be a great way to have your family continue on some of your charitable donations. So you can appoint a child, someone you love and trust. They could then make sure that your donations continue to be given out, or you can say, "Hey, I want to introduce you to charitable giving." And so they could then assign who they want to have the funds go to. So
Mhm.
mom and dad get to do it while they're alive, and then after they pass, their children can then say, "I'd like to continue on your name, your legacy by continuing to make distributions out of it." On the family's behalf. So some great legacy, some great ways to introduce the family to charitable giving. A lot of wonderful benefits moving forward.
Yep, absolutely. Great point, Sean. That was a great question. Glad it was brought up because, yeah, that is a consideration. Like, we don't want it to just kind of get lost in the ether or whatever. Now, you can just designate, you could say, if you didn't have somebody that you wanted to pass it on to or whatever, you could just designate and say, hey, upon my passing, just whatever's left, give it to X charity or split it up into these or put it into the general fund for the organization, right? Like there's a lot of ways, but at the end of the day, all of this money is required to go to some charitable cause. None of it can come back to the family in any way, shape, or form. So,
And also always consult with a state attorney. We are not state attorneys, but
yeah.
you can have your trust, right? Designate a certain percentage or a certain dollar amount to then go into your donor advised fund after you pass.
Hmm.
So lots of unique estate planning opportunities for the donor advised fund, whether that be appointing someone that you love to continue on that donor advised fund, or selecting part of your trust or your will to then have assets go into there and continue to continue your legacy of charitable giving.
Yep, absolutely, absolutely. So really, I want to touch on now, just kind of, driving through, and for the rest of this conversation here this evening, talking about how donor advised funds can help, and then a few different case studies of situations where we've seen it be really powerful and impactful. So the first one is just what we already talked about, and it's accelerating donations into 1 year. So if you're giving equally to charity over time. Again, the scenario where someone's giving, they're tithing to their church and you give $1,000 a month, or, you give to some charity each and every year to the tune of three, five, $7,000. If instead we're like, hey, let's kind of bunch these together and plan for the next 5, 7, 10 years, then we can get some real tax deduction on the front end and still be able to contribute and support those charities over time. And potentially, I'm a believer in the market long term. I know the markets don't look great here lately, right? But if you put 50,000 in there and you are only giving out 3 or 5,000 a year, it's certainly possible that over the course of 5 or 7 years, you still have 30, 40, $50,000 in that account that then you can stretch those dollars even further and continue to support more things that you care about and continue to, enhance and extend that legacy as well.
And I think
Um,
the point you brought up, Bob, that was the most confusing part about these when I was studying for the CFP, because I'm not as smart as Bob, was ultimately that the growth in the account, there's no more benefit, right? The benefit is the year you give it. If it put in 50 and it grows to 100, and then your kids take it over and they start, there's no more tax deduction, right?
mm-mm.
So it's just that initial year. I think that was for me, kind of the hardest part to understand about these funds. But if you did pass it down to your kids and they made contributions to it, they would get the tax deduction the year that they made it. But none of the
Yep.
growth when it's finally delivered. There's no tax benefit there.
Correct. Yep. So again, the only upside there is it's just more money you have to give charitably, right? So, again, it's not designed to get anything else on the back end. But yeah, if we can get that growth, if we can help it grow, and I have clients that donated, and with this number two here in some of their highest earnings years, kind of leading up to retirement, and initially put in, $75,000 that they've been giving out of consistently for the past 10 years, that they still have 45,000 in there, right? So, one of the other ways is to plan around reducing a high income year. So, if maybe you get a big bonus at work, maybe there's big stock options or stock grants that pay out. Maybe you just have a really good sales year, you're a salesman. Maybe your spouse goes back to work and you're making significantly more than you were while that spouse was not working. There's all kinds of ways that income could spike. And in a scenario like this, you could be like Shaun said, oh man, it's December 1st and we want to donate $50,000, but I really don't want to give $50,000 to one place. Like I want to split it up. Putting $50,000 into a donor advised fund can be a great way to get that tax deduction, but then spread out where and how you give that over time. And you're really trying to focus on getting that biggest deduction possible in those highest income years. So being mindful of during your working years, it can make a lot of sense to kind of set these up even earlier in life to be able to build and grow and donate from as you're kind of cycling through those times. Okay. And then, so what I want to finish up with here are just some planning ideas with a donor advised fund, and then we'll get to how we help and finish up with some questions. So, Shaun, again, if there are questions, go ahead and ask me, but I will keep rolling with some of the planning ideas. One of my favorite is just pairing this with Roth conversions. So, for any of you who have, heard me talk enough or kind of been around some of our other webinars, we like to talk a lot about Roth conversions and moving money from IRA dollars over to Roth. When we do that, if we say, hey, we want to do a $100,000 Roth conversion because we're going to be in low income tax years, if we pair that in some way, shape, or form with a donor advised fund contribution, we can, in a way, cancel out some of that Roth conversion and move IRA dollars to Roth dollars and pay very little in tax and set up an account, a fund for us for charitable intentions, right? So, I really love the idea of pairing Roth conversions with donor advised fund contributions. And it can be an extremely tax efficient way to kind of align your goals and help you to maximize your gifts and minimize the amount of tax that we pay to Uncle Sam. Okay. Number two, big one here is donating appreciated securities. So I touched on this a little bit when it comes to just, I made an example out of like Chase stock. But if you have any low basis stock, now this applies not only to donating to a donor advised fund, you can also donate stock directly to a charity. This is something I'm working with a client with right now. He wants to make a donation to his church. He didn't realize that he could just donate some of his ETFs that are highly appreciated instead of cash. And so if you were going to donate $10,000 to a donor advised fund or to any charity, you can just donate shares of stock and effectively, as low as the basis is, all of that gain passes to the charitable entity, or in this case, the donor advised fund. Then, when you sell inside of the donor advised fund, there is zero tax liability because it is a charitable account and there's no taxes due on the sale of appreciated securities in there. So, this can be a great way to be even more tax efficient and increase some of the tax benefit, even more so than cash. Because if we think about it, again, if we wanted to get $50,000 into a donor advised fund and I sold a stock that had a $40,000 gain in it, well, all of a sudden I have to pay capital gains on that 40,000. I donate 50,000, I'm net behind. Whereas if I just donated that stock directly to the institution itself. So, really great way to handle some concentration issues if you have highly appreciated stock and get some money into any charitable vehicle.
And I think this is really powerful, right? I think this is something
Mhm.
that's probably understated. We'll see people say, "Hey, I want to pull some money from my brokerage account and I want to donate it to charity." And it's like, well, when we sell that stock, we're going to realize capital gains tax. You're then going to have the cash to make the donation. Why don't we just donate the actual security to the donor advised fund? We can liquidate it within there, then the cash will come out. No taxes were ever paid. So a
Yep.
very efficient way to avoid taxes and still continue on to charitable giving.
Yep, absolutely. Now, the flip side of that is if you have a stock that's at a capital loss or an investment holding or something like that, in that scenario, you actually want to sell first and donate the cash because then you get the capital loss on your side. But when you got appreciated securities, want to be looking at that. So any of you that are charitably giving, doesn't matter how much, doesn't matter if it's even going to a donor advised fund, keep this in mind for your charitable intents if you do have any appreciated securities outside of an IRA, Roth IRA, 401k, any sort of brokerage account. Okay. Another planning idea or just a benefit, I would say, to these donor advised fund is to simplify gift reporting. So, if you give to a number of charities over the course of the year, like I know that, there's lots of folks that give to all kinds of different places. They give $500 here, $1,000 here, $3,000 here, $250 here, right? There's lots of small donations. And then all of a sudden, you got to gather up all those letters at the beginning of the year and make sure you got it all together. Whereas if you just said, hey, you know what? I'm going to give $5,000 over the course of this year, put that into the donor advised fund. You get one letter for one contribution, and then you can make all those small distributions out of the donor advised fund. And you don't need to worry about tracking all of those little bits and pieces around, right? So, this is a way to just simplify your tax reporting a little bit, simplify your life, and get everything kind of consolidated into one easy to find place. Okay. And then the last one, we touched on this already, but really just aligning values for the next generation, right? Like setting up a donor advised fund, getting your kids and grandkids involved, talking to them about different charities that you or they want to support. And it helps get everybody involved to align values for giving and planning for the next generation, right? So, as Shaun alluded to, whether you're doing this during your lifetime and working, through it with them, or you're just naming them as like the successor trustees of the donor advised fund. This can be a great way to start to kind of plant that seed of philanthropy and, donations and charitable giving and all of that stuff with the next generation without having to have them sit there while you write each check going to each individual thing, right? Like, it could be a conversation around this, it's effectively a very simple family foundation that a donor advised fund is that can just help facilitate the conversation and carry through the charitable planning through to the next generation.
And I'll give a little story of that I had with a client was they were like, well, I just want to set up a 501(c)(3 and then I'll put money in it, then, have my kids be a part of it that way. And I
Mhm.
said, well, be careful, right? 501(c)(3, you're essentially running a business, right? So you're going to have to, go through all the compliance documentation. You need to find three board members here in the state of Ohio, right? Most states have some board that's required. They're not allowed to be on there typically for their entire lifetime. And so this can make it an easier way to achieve your goals is by setting up a donor advised fund, having them be on there, successor trustees, rather than going through the process of setting up a 501(c)(3 and getting the charitable contribution that way.
Yep. Much more expensive and difficult to run to set up a full, LLC or anything like that versus the donor advised fund is a very effective, simple way to get access to something very similar there. So, um, so wrapping up here, just talking about how balanced wealth, how we can help you here. It's really just starting with a review of your goals and charitable intent, right? Again, I was uh, motivated to put on this webinar because I had three different client conversations where a donor advised fund came up where it was honestly a little bit of a shortcoming of mine that I didn't dig deep enough to ask and make sure. But we want to make sure that we're being involved on all portions of your financial planning picture, not just investments and insurance and taxes and all that, but charitable intentions, and making sure that we're helping you there because then we can go through and we can recognize where the planning opportunities may be and run some income projections to say, how beneficial will this be? Like put some dollars and cents to it to say, hey, if we get an extra $10,000 deduction, like in our example, how much money does that save us on taxes? How beneficial is it to do something like this? And then we can help you, again, run those tax scenarios and get maximum benefit. And of course, work through the best plan to carry out the execution for the donor advised fund. Um, Important considerations just before we wrap up and everything here. There was one change to IRS regulations that just went into effect for 2026. So so if you're married filing jointly, up to $2,000 of cash donations can be deducted from your taxes, even if you don't itemize. So for that example I gave, that sort of, trying to get above the threshold for itemized deductions, you do get a little bit of benefit now. This was again, just with the One Big Beautiful Bill Act just changed for 2026. So you still can do that. If you're like, hey, I think a donor advised fund's too complicated, not something for me, we can still do this as you're giving to charity. But like, just start thinking about how much do you plan to give to charity and for how long? Some folks it's tied to their income. Some folks they have a set dollar amount. Some folks have, just kind of a needs based. So kind of think about that. Do you have appreciated securities is a big question there. What are your other resources and income projections? And understanding that the kids can inherit the donor advised fund, but it all still needs to go to charity, right? So doing some legacy planning, and if you want each kid to get X number of dollars, and so you don't want to tie up too much over here. It's trying to balance those two things together for those overall goals and long-term plan. So, Shaun, that's everything I had here for tonight. I think outside of some of our other webinars, this one's a little bit shorter, but it's very specific and to the point. And so we hope it was helpful. Are there any questions that we missed, Shaun, that came through? Or B, is there anything that you want to add or any additional comments or thoughts before we wrap up here for this evening?
No other additional questions came in. I think it was really short, concise, and provide a lot of clarity. So if you do have questions after watching this, please reach out. We're happy to help, happy to get together and kind of go over that financial plan to you to make sure we're maximizing every resource that's available for you. And also a great drill for us to dive deeper into these donor advised funds.
Yep. Absolutely. Well, for compliance sake, I'm putting up our last slide here just for, 30 seconds or whatever, just to make sure we get it out here. But, thank you everybody for being on here this evening. Shaun, thanks for being here and talking through this with me. You did great in Ryan's stead. So, real thrilled with how you performed as our technical leader. And we'll see everybody next month for our next webinar, and there'll be more info to come on that one here in the coming days.
Thanks, everyone. Hopefully, Bob, this the IT thing is actually true and this recorded. We'll find out. But thanks, everyone.
Yeah, let's hope so, right? All right, sounds good. Bye, everyone. Have a good evening.